Hello, everyone, and thanks so much for joining us today. My name is Steve, and I'm joined as well by Yulia and Lee. We're all team members of the customer success team here at Snap, and we're the members that you'll typically interact with if you're giving us a call or sending us an email related to questions on the software. Today's webinar is going to be focused on creating quick and simple projections in Snap. A lot of our typical support webinars are focused on some of the more advanced capabilities, the customizable features that allow you to create comprehensive plans in Snap. But we wanted to take an opportunity to show some of the automated calculators and quick ways that you can answer client questions in order to provide more plans to your clients. If you can just let me know whether you can hear me okay in the questions box of the GoToWebinar. That way I can continue on confidently sharing my screen and continuing to outline today's session. Today's session is approved by FP Canada for continuing education credits. So it'll be eligible for 1 CE credit in the category of financial planning for FP Canada certificates, and/or 1 CE credit in the category of professional development for MFDA licensed representatives. After today's session is complete, within 2 hours, we'll send you an email with a few things included. We'll have a recording for today's session. So if you need to step away for any reason, or if you want to revisit anything that we did during the session, there will be a recording available. We'll also share a survey with a few questions, just your first and last name and then your email address, so that we can create a custom certificate for the CE credit and send that to you directly. And we'll have those sent out by the end of the year, just so that you can apply those towards your CE needs. Awesome, thanks everyone for letting me know that you can hear me okay. This is also where you will be able to submit any questions during the session today. So Yulia and Lee will both be monitoring the questions. We'll try to get back to as many as we can live. And if we're not able to respond during today's session, we will get back to you by email within the next few days. Today's session, as I mentioned, is focused on creating quick and simple plans. We're going to create 3 projections, all from scratch, so that you can see the beginning to end workflow to try and answer these types of common client questions. In the first case, we'll be illustrating the savings and withdrawals that will be used to achieve a consistent and sustainable lifetime spending level. So this use case will be to help clients who don't necessarily have a specific goal in mind for their money, but they're looking for guidance on what they should be doing so that they're not caught off guard in the future. The second case that we'll be building is to determine the required savings that a client needs to make in order to achieve their target retirement spending goal. And then the last projection that we'll create is for a combined couple who is saving towards a first home. So we're going to be modeling a first home purchase. And in addition to that, we'll also show the maximum retirement spending that they'll have available given the projection that we're going to create for them today. At the end, we'll leave some dedicated time to questions, but if you have any questions during the session, please feel free to submit those along the way, and we'll try to answer them live. Before we jump into the software, I did want to take a couple of minutes to just focus on the next major feature that we'll be working on at Snap. You may have received an email 2 weeks ago from our product manager, Jim, where he shared these 2 files. So the files are also available as attachments to today's GoToWebinar session. So if you go to the handout section, you can download the files, reference them, and then if you would like to provide any feedback, you can send that to our support team, of course, at support@snapprojections.com, or you can reply to Jim's email from November 30th, where he sent out a short 2-minute video outlining what he's thinking for these features. So this is a 1-page plan summary, or a snapshot as it's being called, and the goal is to provide a combination of automatic values and information along with customizable input settings. So you'll be able to customize things like other considerations, next steps, and goals, while Snap is able to automatically summarize things like the average spending, whether the goal is on track or underfunded, and then having selectable charts. So if you do have any feedback on these mockups, or if you'd like us to factor in other considerations as we work towards these one-page summaries, please feel free to reach out to our team and we'll be happy to factor your feedback into the process. The second example is if the client is overfunded. So here we can see that the chart is slightly different, the recommendations are slightly different. So it'll be customizable and automated to help you summarize the projection as best as possible. And with that, let's jump into the software and start creating our projections for today. So in Snap, as you're likely aware, you have your clients page where you can click on any client name in order to go into your existing scenarios. To get started on a new scenario, we'll just click Add New Client. We'll input the client's first and last name, their date of birth, and their province of residence. There are three main areas to the Snap software. There's the scenario setup, which we're going to progress through now. Then we'll go to the planning pages where all of those input values will come together to show us Carl's life on one page. And then once we're done customizing values for a specific year or for periods throughout the projection, we'll proceed to the client report in order to select the charts, tables, and commentary that we would like. I'll click next and go to the general settings page. One very important consideration, especially as we get to the end of a calendar year, is that you can start your projections as of the following year. So instead of having to worry about the last 2 weeks of December in this case, we can click 2024 on this page and the plan will start effective January 1st, 2024. So that's very common as we get towards the end of the year. There are other approaches available. If you would like to still show 2023, we can do things like adjusting the rates of returns and other assumptions. So if you do have questions about starting a plan midway through the year, we have a couple of articles and our support team is always available to help as well. So with Carl's case, he's a fairly young client and he doesn't have any specific goals that he's working towards. He really just wants to make sure that he's on track to be financially independent by the age of 60. So he doesn't know that he'll retire at 60, but he doesn't want to assume that he'll need employment income from that point forward in the plan. So that's what we're going to work towards today. And we're going to have Snap use some automatic calculators to help us to come up with a recommended projection for Carl's case. So we're going to start the plan in 2024. We're going to end employment income as of age 60, and we're going to run the projection until age 100. We'll use the default inflation rates from FP Canada, and then I have pre-filled the rate of return defaults for this account. So we've adjusted the FP Canada assumptions, reduced them for expected management fees, and these are our resulting net of fee returns. And once you've selected these, you can always save your default settings for all new scenarios, and those will show up automatically. I'll click next and go to the expenses page. So we've added quite a bit of expense customization in the last few months, but we actually don't even need to use this page in certain client circumstances. So if you don't know what your client's base spending is, we can actually skip this page altogether and we can have Snap help us to calculate what their spending need would be or could be. So I'll skip the expenses page and go to incomes. In this case, Carl's currently earning $120,000, and we have the ability to index that either at a specific percentage, if I change the percentage here, or if I delete the value altogether. So once again, if I clear this cell so there's no values entered, you'll see in gray at the back it's showing general inflation, which means that it's just going to index the employment income at the rate of inflation that we set previously on our general settings page. This is being input as employment income, so Snap will deduct CPP and EI. It's being taxed appropriately, earning RSP room. It's going to start in the first year of the plan and run until the end of the year that the client turns 59. If we wanted to end the employment income partway through the year, we can click on this gear symbol in the to age cell and we can change the date. So if a client is going to work until their birthday on June 30th, we can actually just prorate the amount of income in that final year of the plan. There's no defined benefit pension plan. We could add rental income if we wanted to, if the client had it. But in this case, we'll just click next and go to the assets page. By default, there's a non-registered account added to each of your projections so that Snap always has a place that it can allocate future surpluses if needed. And it conservatively assumes 100% cash allocation for that default account. So I'm going to update this account and call this future non-reg. So the client doesn't currently have a non-registered account, but if in the future they need one for any excess savings, we'll have that column available in the projection. So I'll update the asset allocation to what the client would likely invest the money into. So we'll use 30% fixed income and 70% equity. Carl also has an existing tax-free savings account with $70,000 invested as 30% fixed income, 70% equity. And he has an RSP currently with $90,000 similarly invested. And you'll see Snap has pre-filled all of the rates of return from our general settings page. And then it's taken the average based off of our asset allocation and calculated a total rate of return for the portfolio. We could, if we wanted to, customize any of the individual rates of return on an account by account basis. So if this future non-reg was going to earn 6% on the equity allocation, we could adjust that just for this specific account. Now that we're done entering in the account balances, we also have the option above the table of accounts to customize some of the registered settings. So if I click TFSA, you'll see that we can customize the TFSA contribution room. Now this is still currently showing $6,500 for next year. We update all of the annual tax values and contribution rooms and all of that information over the new year. So when you sign back in January, these values will be updated for the most current government values. So that's marginal tax rates, OAS values, CPP, and any other posted information that is available at that time. So I'll update this for Carl's current carry forward room. So they have 3,000 existing room plus the 7,000 that they'll get at the start of next year. So we'll enter 10,000 for their available contributions starting in 2024. We'll go to the RSP and we can input his available contribution room from the most recent notice of assessment. In this case, it's 30,000. I'll go back to the assets and scroll down to the real asset section where I can input his home, which has a current value of 500,000, a cost of 400,000. Appreciation at the rate of inflation, we can customize that if desired. And we do have the option to model a future purchase age or a future sale age. We'll be doing a future purchase age in the third scenario today to show you how that can be used. And then we'll set capital gain taxes no because this is their primary residence. I'll click next and go to debts to input his remaining mortgage balance, which is 250,000 with a 5% interest rate. And we're going to have $1,800 as the monthly payments. In the real asset column, we can click on home in order to link this debt to the home that we just added on the assets page. And that way, if he sells the home at any time in the plan, if there's a remaining balance, Snap will repay the mortgage before using the proceeds for any other purpose in the projection. I'll click next and go to the government benefits page. Now in this case, because Carl is fairly young, we don't know exactly what his future CPP benefits will be. We can see that by default, Snap starts CPP when he turns 60, and it's assuming that he'll receive the national average of 55% of the maximum. So we don't know exactly when he'll start it or how much he'll receive. We can, if we want, use these default assumptions just as an illustration of where Carl is headed. If we wanted to, because we know that Carl's a high earner, we could adjust the maximum, the percent of maximum to something a bit higher if he does expect to continue working up until the time that he retires. So we'll go with a start age of 60, percent of maximum of 80, and then we can have a conversation with Carl that we would revisit the best decision closer to with all of the numbers available. Similarly, for old age security, we have a start age of 65, the earliest available given his retirement age, and then we have the percent of maximum as 100% by default. As I mentioned, as of 2024, these numbers will be updated for the most current values. Now we've taken about 8 minutes, and we've input all of Carl's personal information into the plan. You'll see on the left that we do still have additional input pages available. We could add insurance policies, conduct life needs analysis to see if more insurance could be recommended. We can add RESPs and corporations when applicable, and then we can customize additional settings if we want to further tailor the plan. But in this case, we're going to click on planning pages to go and see how all of this information from Carl's case is going to come together to show us his life on one page. So on the planning page, we have a lot of key information that we can use to help with our discussion with Carl. On the left, we have the year of the projection and our client's age. We can see the discretionary cash flow that Snap has calculated Carl has each year of the plan prior to retirement. So once again, before the age of retirement, Snap is simply assuming that any remaining cash flow that the client has is just going to be spent, unless we've explicitly requested that it get used to pay taxes as it is here, or his mortgage, which it is over here. Anything other than the taxes and mortgage in this case is going to be spent in the projection, and it will show up here. As we scroll down and reach the age of retirement, we can see in 2050, there's no target spending. We can either input that ourselves, or we can have Snap calculate a sustainable level of spending that would use up all of his account balances by the end of the projection. So you have control whether you want Snap to calculate and determine deposits and withdrawals, or whether you would like to do that manually by clicking on any of these contribution and withdrawal values and inputting a dollar amount. So with Carl's case, he doesn't currently have any sort of savings strategy in place. He has good financial habits, but he just kind of saves on an ad hoc basis every time that he builds up a bit of money. But he'd like a bit more structure to his financial situation. And so we're going to have Snap help us to calculate a consistent, sustainable lifestyle spending amount that will allow Carl to save a bit today and continue his lifestyle spending indefinitely. In order to do that, we need to use what's called the cash flow management in Snap, which is the automated calculator that will take over deposits and withdrawals for us in order to achieve a target spending each year of the plan. And we can use the cash flow management as of the first year of the plan by either clicking on this white radio button, which will start the cash flow management in the first year, or we can click on the teal blue box at the top here and change the start age to 34. So if we do either of those approaches, once we've clicked Run Scenario and the Run Scenario button is turning green, you'll see that the real base spending is now customizable. We can enter in any dollar amount that we want, or we can have Snap calculate that value by using the Recommendations tool. So I'll click Recommendations in the top right, and then I'll click on Sustainable Spending. So Snap is now calculating how much Carl can spend each year of the plan in today's dollars without running out of money until the final year. So in this case, it ends up being $52,249 that he could spend on a consistent basis. So we apply that to the projection. We can see Snap automatically updates the real expense column, and then it indexes those values each year of the plan at the rate of inflation and shows the actual amount of spending that Carl is going to do each year in the nominal base expense column. As we continue to the right on the planning page, we can see that Snap is going to take this 120K employment income and anything that isn't needed to either cover his nominal expenses, pay his CPP and EI and taxes, or go towards his mortgage over here, Snap is going to automatically contribute that surplus into his capital assets based off of the cash flow management order. So we can see Snap starts making RSP contributions. It continues to increase over time as his salary increases. Then once he runs out of contribution room in the RSP, we can see that Snap starts making TFSA contributions for the difference. We continue making TFSA contributions until we run out of room there. And then we, for the last few years before retirement, are maxing out the RSP, maxing out the TFSA, and putting some money into the non-reg. And we can see that the contributions really increase as of about age 52, because that's the point where he's repaid his mortgage and he has a lot more cash flow available for other purposes. If we hover our mouse over top of any of these contribution values on the planning page, you can see the amount of room that's assumed to be available as of that year. So in the first year, there's that 30,000 figure that we input on the assets page. As we continue to contribute, we can see that Snap is recalculating the contribution room based off of new room that he's earned. And then eventually in this final year, we can see that he's almost caught up and used up all of his contribution room. And that's why as of this year, it starts switching over and using some TFSA. So that's the accumulation period. And then once the client is set to retire, or as we've illustrated here, once they stop working at age 60, we can see that Snap turns around and starts withdrawing the money needed from the accounts in order to reach the target spending level. So Snap is automatically taking from the non-reg, it's topping up his income from the RSP up to the personal amount to get that money out tax-free. And then it's using a combination of TFSA and RIF money for the remainder of the plan and depleting all of the assets by the end. So without needing to input or know too much about specific goals for Carl, this is a very informative roadmap for where he can head and roughly how much he needs to save each year without saving too much or without saving not enough. So now that we've created this projection, we can review it with Carl through a few different options. We have the charts that are all very interactive. So we can hover our mouse over top of the legend items in order to highlight specific values. So we have his base spending over time, his income taxes, his mortgage payments. We can scroll down to the cash inflows and similarly focus on where his money is assumed to be coming from over time, whether it's withdrawals from capital assets or government benefits. And then we have the net worth chart where we can interact and remove values if we want from the chart. So here we've removed the real asset so that we can really focus on the liquid net worth portion of his projection. Once we're done reviewing the plan and we're comfortable moving ahead, we can then go to the client report. On the left, you have all of the pages available for inclusion, and then you can check or uncheck any of the pages using these checkboxes. That's going to indicate which ones you want to include and which ones you want to exclude. Once you're comfortable with the pages to include, you can click Report Preview, and then you can review it for your branding, your selected background, and then the pages that you've included. Now, one great feature that we recently released is the option to reorder the pages. So in the past, you're likely familiar that these were the orders, or this was the order that all reports were generated in. It would go cover page, then note to reader, then goals and objectives. Now, if you go into report settings, you can scroll down to the section for custom order and you can reorder these pages. So if I want the net worth to be the first chart that my client interacts with, I can drag that up to the top of the chart section, and then I can click save at the bottom of this page, and that's going to adjust the order in my report. So now when I go to report preview, I can scroll down and right after the assumptions page, I'll see the net worth chart. So a new feature, again, report settings, custom order, you can drag and drop to rearrange and then click save. And if you want to go back to the default settings, you can just click reset and then click save. And with all of the new customization that we've added to the report settings section, we are in the process of updating this page to make it a bit more customized. So we'll have different settings for each of these categories, and you'll be able to switch between them, very similar to the scenario setup flow. So small change that will be coming to this page, but it'll allow you to more easily interact with these custom settings. Perfect. So now that we've finished customizing the chart and the order, we can then go to generate PDF, and that's the file that we can share with Carl as a takeaway from all of our discussions. So that's been a lot to start off with. I'm going to pause there, see if there's any questions that have come in related to this client scenario.
Thanks a lot, Steve. And yeah, there's been a few questions that are pretty relevant here that I think would be helpful to review, especially kind of going back to basics and the cash flow management in general. So can you just talk a little bit more about when you would decide to start the cash flow at the beginning of the plan versus at retirement?
Yeah, so The main time that you would start the cash flow management at the beginning of the plan is if one of two things is true. If the client is 100% certain about their budget, like if they know that they are spending, $60,000 per year and they've done, they've reviewed their credit cards, they track things in Excel or in some other format, and they know with certainty that they are spending 60,000 a year, then you can model that in the projection using the cash flow management right from the start of the plan. And what Snap is going to do is it will automatically save the surplus cash flow throughout the projection. So if they know what they're spending, that's one time that you can use this approach. The reason that we typically turn it off until retirement is because it is somewhat dangerous to put in an incorrect spending assumption. So if the client says they're spending 40,000, but they're actually spending 60, what's going to happen is Snap is going to have this huge surplus that it's going to assume is being saved over time. But if these contributions to the TFSA and the RSP aren't actually happening, then this is an incorrect projection. So we really want to use this if the client knows for certain what they're spending on an annual basis. The other time that it can be useful is if the client is flexible in their finances. So let's say that they don't have a current savings goal, or they're looking to you or to this process to give them a monthly budget that they will stick to. That's when we can also use this CFM from the start. All that we need to do with the client in order for this scenario to be useful is to confirm with them that they are going to start making these contributions. So we could set up a pack into their RSP for roughly $2,500 a month in order to start achieving this savings goal. So as long as these contributions are happening in the client's real life, that's when we can use the CFM right from the start. Otherwise, what's more common is we would start the CFM from retirement, and we would conservatively enter these savings amounts ourselves. So if we know that they're saving $6,000 a year to the TFSA, we would just enter that and assume that everything else is being spent. So this is the more common approach, but both can be valid.
Terrific. Okay. Yeah, so I think the other question had to do with the optimization of taxes each year, and how come Snap is withdrawing from non-registered first and then TFSA and then registered, and can you change that?
Yeah, absolutely. So I'll just put the plan back to how we had it. So we're just going back to recommendations, calculating the sustainable spending right from the first year. And then we can go to retirement. So if we scroll down to age 60, we can see that Snap is first using the non-reg, then it's using the TFSA, and then it's using the RIF minimum. And there's a small exception here where it's taking some money from the RSP because we have no taxable income, or because our taxable income is below the personal amount. So if we're able to get out tax-free money, Snap will automatically take it from the RSP. And so this is a default drawdown strategy that's referred to as a tax deferral strategy that is a very common and efficient starting point for most client scenarios. So we're getting rid of the non-registered account because these returns are taxable. So there's a tax drag if we keep this money invested going forward. And then we're using TFSA next so that we can kind of combine TFSA income with RSP income to blend taxable income over time in the projection. We can see this order by going to the capital assets section and then showing the CFM order column. So that's going to add 2 new columns to your planning page. One shows the order of contributions. So up at the top, we're contributing to the RSP first, then the TFSA, and then the non-reg. And when we're withdrawing, we're taking from the non-reg, then the TFSA, and then the RSP. So you can click on this and customize the order to any one that you'd like. You could also combine the default order with overrides. So if you wanted to take, $20,000 a year out of the TFSA, you could simply enter in an override, copy that down for a specific period, and then Snap will blend those withdrawals with the other withdrawals happening in the plan. So there's lots of customizability available, and we are continuing to work on the automated logic in Snap to further improve the starting point for each of your projection. If you would like to learn more about this topic of drawdown strategies, and we did a very comprehensive webinar recently that reviewed some recent FP Canada research. So if you go to Help Center, Webinars, and then the Help Your Clients Get the Most from Their Money in Retirement talks a lot about the different drawdown strategies and the research that's been done into the best approach.
Thanks, Steve. And there's definitely more questions, but I think it would make sense if you continued on. And if we don't get to your question that you've asked, then we will be emailing you back afterwards.
Perfect. Awesome. All right, so that's it for Carl's case. We may jump back with future questions, but in this scenario, I'm going to go back to our clients list so that we can again start from scratch and input a new scenario. This time we have a different client profile. So we're going to be creating a projection for Diana Campbell. So I'll input her name, date of birth, and province of residence as British Columbia. This time we're creating a projection for a client who is 10 years away from retirement and has a very specific retirement goal in mind that they're looking to see whether they're on track, and if they're not on track, what do they need to do to get themselves on track. So we wanted to provide a couple different types of client questions in this webinar. The first scenario that we did for Carl is really those clients who don't know what they want to do. They don't know what's possible even. And so we're creating a sustainable spending scenario from the first year of the plan to show them how they can combine current state savings with future withdrawals in order to consistently spend at a reasonable level throughout their whole life. So that's one type of client that you might interact with where they don't know what they want to do next. They're looking for guidance on what is possible. The second type of client that we'll go through now is someone who has a very specific goal in mind and they want help getting there. So I'll click next and go to the general settings page. Once again, because we're so far into the year, we'll start the projection as of 2024. Diana has a target retirement age of 65, and we're going to run the projection until age 100. My default settings for inflation and rates of return have been saved and pre-filled here. I'll click next and go to expenses. And so this base expense figure, as we saw from the last scenario, is the amount of annual spending the client wants to do after taxes have been paid for. So this is net of tax annual amount from the age of retirement onwards in the projection. That's the default starting point for each of your plans. So she has a target spending of $5,000 a month or $60,000 per year that we want to try and achieve. I'll click next and go to her income page where she's currently earning $140,000. We'll once again delete the value in the indexing box to link this value to the general inflation rate. And similarly, it's employment, taxed, RSP eligible, and we can see that by default, it's just ending in the final year before the year where she turns 65. If we wanted to prorate this, we could just change the exact date that it's going to stop. She also has a defined benefit pension plan from a previous employer, and that has a expected amount as of age 65 of 25,000 and an annual indexing of 1%. So we have start age of 65, and then the period age 65 and after, we have this $25,000 annual amount. If the client had a bridge benefit and was starting before age 65, we could enter that pre-age 65 amount that includes the bridge benefit as well. I'll click next and go to the assets page, and we'll enter in very similar information to our last scenario. In this case, she already has a non-registered account, so we'll just delete the default and we can add in our own account settings. So we have a TFSA with 90,000. And that's invested as 40% fixed income, 60% equity. We have a personal RSP with 240,000. We have a group RSP with 40,000. And we have a non-reg with 50,000. We can once again go to the registered account tabs. For TFSA, we'll update this to 7,000. That'll be updated starting January 2024. And then we'll go to the RSP page and update based off of the most recent notice of assessment. So she has 50,000 available. And then we can go to the employer matching tab, select her group RRSP, link it to her employment income, and indicate that she and her employer are each contributing 5% of her salary into this group RSP each year. I'll go back to the table of assets, scroll down to the real assets and input her home. I'll click next to go to the debts page where we can enter in her mortgage with a balance of 150,000, 5% interest, and monthly payments of 1,600. We can again link the debt to the home so that we would repay the debt if we sell the property at any time prior to the mortgage being repaid. I'll click next and go to government benefits. Here we're going to start CPP as of her retirement of 65. Again, we have the default national average 55% pre-filled. This is because Snap doesn't have all of the employment history that it needs in order to calculate for that client. And so we would need to customize that either through an approximation, through getting the client's Service Canada statement, or their history of CPP contributions. And then for old age security, we'll leave that as 65 with 100%. Similar to before, we do have these pages available when relevant, but in this particular case, we won't need to adjust any of these settings or input anything else. So we'll click planning pages and go to the summary of the report, or sorry, the summary of the plan. So again, we start in 2024. Our client's age that year will be 55. We can see that Snap is calculating the discretionary spending that's assumed to be available. So it's doing that by taking the employment income of 140,000. It subtracts off the CPP and EI value, subtracts off the total tax, subtracts off her portion of the group RSP contributions, and then subtracts off her mortgage and assumes that the rest is going to be spent each year. That continues until retirement, at which point our 60,000 target has been entered. Snap is indexing that forward for inflation, and it continues to spend at that level as long as it can, as long as there are assets remaining in the plan. So here we can see in 2061 at age 92, this is where she would start to run into cash flow issues. We can see that by going over to the capital asset section where we have all of her accounts listed. We can scroll down and see that eventually the group and personal RSPs get depleted as of that year of the shortfall. So in this case, Diana has come to us. She wants to retire and be able to spend 60,000 a year, and she's wondering whether that's possible, and if not, what she can do. So right away, we can tell her that she's a bit off track for that goal. There's a shortfall here of about $500,000 as of the last year of the plan. And we can again use that recommendations tool to help with some quick automatic calculations to see what her options are from here. So we'll click recommendations. We can see a summary of the goal. So she wants to retire at 65 with target spending of 60,000. She's underfunded by 550,000. And now we can figure out what we can do about it. So the first thing that we could do is adjust the retirement age. So Snap will calculate how much longer she would have to work in order to fill the gap and avoid the shortfall. So in this case, she could either work until age 68, 3 extra years, or we could see what her additional annual savings need would be in order to achieve this target. So in this case, she would have to contribute about 16,000 extra per year gross into her accounts. After the RSP tax rebate is factored in, it would cost her net about 11,000 a year. So she's going to get about 5,500 back in a tax refund by making that contribution. That would bring her total contributions, including her group RSP, to 24,000 a year because she's already contributing 7,000. And so her total after-tax cash flow that is going to savings each year would then be 15,500. So we can click apply and run, and that's going to enter those additional savings into the plan. So now we can see this new column of CFM savings. So that's the after-tax cash flow that's being allocated to extra savings. And we can see that Snap is initially contributing that fully into the personal RSP. Once she catches up on her contribution room, it starts to use a combination of the personal RSP and the TFSA until she retires. If we go to the left, now we can see that her discretionary cash flow has been recalculated, so it's been reduced by those additional contributions. Once we get down to age 65, when she's retiring with her target spending of $60,000 a year, if we scroll down, we can now see that there's no longer any pink shading. It's fully funded. We can scroll over to the capital assets and see that the accounts are being depleted in the final year of the plan. So we've been able to very quickly both demonstrate that she's not quite on track for her goal and give her very actionable next steps about what she needs to do in order to get her plan on track by the time that she retires. Again, we can review this in the form of the various charts. So whether that's the cash outflow chart, the inflow table, or the net worth. And then we can go into client report, select which information we want to share with Diana, create a PDF, and then share that with them for further review. So that's the second type of client that you might come across where they have a very specific goal, and we can use the recommendations tool to give them options of how to get the plan 100% funded. So I'll pause there, see if there's any questions before we move on to our last scenario of saving for a first home.
Okay, one question that's come up is just to do with RSP contributions, and it was actually asked about the last scenario as well. Just how does Snap take into account the tax savings that will happen based on RSP contributions?
Yeah, so automatically the tax refund related to any RSP contribution is factored into the year that the contribution is made. So as an example, if I set this RSP contribution to 0, my taxable income for the year is going to go up and my taxes payable will go up. Right now, as it currently stands, if I click on taxable income details, I can see my employment income and I can see all of the registered contributions that are reducing that taxable income and arriving at the 116,000 figure. So as of right now, including the contribution, my tax bill is 25,500. But if I tell Snap I don't want to make an RSP contribution by entering a 0, this total tax figure for the first year is going to increase. So now we're paying 32,464. So the tax refund automatically gets factored in as you enter in any sort of RSP contribution because the taxable income is automatically being adjusted. So when you enter the contribution, taxable income is reduced, taxes are reduced, and the assumption would be that that cash flow is available for any other purpose in the plan. If you have a target spending, then Snap might save that surplus to another account. If you don't have a target spending, then Snap is just going to increase the amount of spending being done that year.
Terrific. Yeah, that was great, Steve. Thanks.
Awesome. All right, so now let's jump into the third and final scenario. So I'll go back to my clients list. I'll click add new client. And this time we're going to do a projection for a combined couple because there are a few minor differences in the experience once you have 2 individuals in the plan instead of just 1. So I'll enter in the first client, so Monica Gibson, born 1992, sorry. And living in Ontario. At the bottom here, I can click add spouse, and that's going to allow me to enter in a second individual in the plan. So we have Eric Gibson, also born 1992. So now we have Monica and Eric. The main thing that you'll see is different is we now have 2 options in the top left. We have our main client and the spouse, and we can toggle back and forth between them as we're entering information through the scenario setup flow. And then we can also toggle between them once we get to the planning page section. So it really kind of just expands the projection. It duplicates a lot of the available pages, one related to each individual. So I'll click next and go to the general settings page. We'll again start the year as of 2024, retirement age of 65. We have all of our default settings pre-filled here. I'll click next and go to the expenses. Similar to the first scenario that we did, there's no current target spending goal or budget or anything. And this is quite common with younger clients who might be 30 years or more away from any sort of retirement. They're focused on what they want to do today, which is save towards their first home purchase. But we want to kind of include the full projection to give them a sense of where things are headed with everything that we're entering. So we don't need to spend a ton of time on assumptions about retirement age, spending needs. We can just have the software help us to calculate what would be available given all of our other assumptions in the plan. So it gives them an idea without having to really focus on that section of the projection. So I'll leave the expenses blank for now, and we'll have Snap help us to calculate what would be available once they retire, given all of our other assumptions. I'll click next and go to incomes. So I can enter in the employment income for Monica, who's currently earning 90,000. We'll clear that and index that for inflation. And I have two options when I'm creating a plan for a couple. I can either continue to click next and go down through all of these pages for the first individual, for Monica, or I can toggle back and forth between the individuals on each page. So now I can click Eric, enter in his employment income, and then we can go to the next page of assets. So it depends on your preferences, which approach you would like. Most commonly, people will tend to enter in on a page-by-page basis. So incomes, enter it for both, assets, enter it for both, and then continue on. So we can go to Monica's assets page. We'll call this future non-reg. We'll leave the value as 0 because they don't currently have a non-registered account. And we'll change that asset allocation to 30% fixed income, 70% equity. Next, we can add in the existing tax-free savings, so 25,000. The RSP, which has 40,000. And then the new account that we just added to the software is the first home savings account. So you can now model the use of a first home savings account towards a client's first home purchase in a projection. So all of the coding and everything is programmed in now. We'll walk through some of that. And then we do have a dedicated video outlining the more granular rules that you can review as needed. So in this case, the first home savings is fully invested in fixed income products because they're going to be using that money very shortly. So we've entered in their starting balance as of January 1st, 2024. We can go across the top of the accounts, click on TFSA, adjust the room that's available. So in this case, they have quite a bit of carry forward room. So 65,000. The RSP, they have 40,000. And then the first home savings account, we can customize some of the settings here. So we have the opening age, which was last year for these clients. You can customize that as needed. We have the carry forward room. So if they didn't make a contribution last year and they were able to carry that forward to this year, we could enter in up to 8,000 available here, and that's going to help Snap with its automatic calculations. And then we can enter in any previous contributions made so that Snap knows to reduce the 40,000 lifetime contribution room. And then the next thing that we can do is we can actually link the first home savings account to a first home purchase in the software. So we'll enter in a real asset purchase shortly, and then we can link the first home account to that purchase to automatically withdraw a qualifying withdrawal in the year of the transaction. So I'll go back to the table of assets, click on Eric's name, and do a similar approach here. So future non-reg, invested as 30% fixed income and 70% equity. TFSA, 30,000. RSP of 40,000. And then first home savings, $8,000, 100% as fixed income. And we'll adjust the TFSA room, RSP room, and the first home previous contributions. And then we can scroll down and we can model in their new home purchase. So they want to spend $750,000 as of the year that they turn 38. So we'll enter in cost that they're going to purchase it for, the age or year that they're going to purchase that in, and then we'll set it as joint with the capital gain tax as no. Now that we've added in the new home, we can come back up to the first home savings account, and then we can link the first home to the home purchase so that it gets used. And we can do the same for Monica. We'll just link directly the first home to the first home savings account. Now this is a fully optional step. This just means that Snap is automatically going to make a qualifying withdrawal in that year. You could always do that manually on the planning page, but this just saves you needing to track. And this way, if you change the purchase age of the property, Snap is automatically going to adjust when the withdrawal comes out of the first home savings account. Terrific. So we've entered in all of their assets. We can click next and enter in a future dated mortgage. So this is the mortgage that they're going to take out in order to pay for the rest of the purchase price. So they're going to borrow $675,000. They're going to put down $75,000 themselves. They're going to do that as of age 38. So this is just asking us to make sure that this is a future dated debt, meaning that they will get $675,000 as of the year for cash flow. And then we have monthly payments of $4,000. We can set that as joint and link that to the home. Then we can click next and go to government benefits. In this case, because the clients are right around the YMPE level with their employment income, we don't want to assume that they'll continue to earn above or at the YMPE for their whole working life. The client's comfortable leaving the national average assumption of 55%. So we'll just leave that as is. As they get closer to retirement, we can always revisit these values and see how they've been progressing and what their future employment assumptions are. But for the time being, we'll just leave the CPP default as national average and OAS as the full amount. And so now we've entered in all the information for Monica and Eric. We can proceed to the planning page and take a look at the final product. So with a combined scenario that includes both a client and their spouse, you'll see that there's now 3 planning pages. So there's one for Monica, where we can see her personal information like her employment income, her investment accounts. We can make contributions from here. We can click on Eric's name and do the same thing for his values. And then we can click on combined and see how all of that information comes together for the overall household. So lots of viewing options, and you'll see at the top of each of the column sections, we can expand or collapse in order to see more or less information depending on our needs. So I'm going to make a few final adjustments to the plan, and then we'll be ready to have a summary conversation with Monica and Eric. So the first thing is to enter in their annual contributions. So they're contributing $10,000 a year into the RSP and $3,000 a year into the TFSA each. So I'll put that in here. And then they're contributing $8,000 into the first home savings account. And I can actually copy that down as long as I want. And when I click run scenario, Snap is going to stop those. Oh, sorry. We're going to make qualifying contributions. So we have qualifying contributions of 8,000. We'll copy that all the way down. And then Snap is going to automatically stop our contributions once we've run out of room. So it's tracking that 40,000 maximum, and it will change our value to 0 once applicable. So we can see here, once we get to a total of 40,000 in contributions, Snap has corrected ours, it's put its guardrails in place and stopped those ongoing contributions. We can see that once the client is set to purchase their new home at age 38, Snap is automatically making a qualifying withdrawal, so that's a non-taxable cash flow out of the account, and it's applying that towards the purchase in addition to the mortgage. So that's everything that we need to enter for Monica's personal planning page. So we have all of her contributions going forward, and now we can do the same thing for Eric. So I'll scroll over to his accounts. So 3,000 into the TFSA. And you'll see that I can make multiple changes all at the same time without having to click on Run Scenario. So I can just edit a bunch of contributions. And then once I'm ready to recalculate the plan, I'll click Run Scenario, and that's going to refresh all of the numbers for us. So once again, Snap has corrected our contributions to prevent over-contributing. And now we're ready to review the combined planning page to see how things are looking. So based off of their employment income of $170,000 total, if they continue to make $6,000 a year of contributions to the TFSA, $20,000 to the RSP, and $16,000 to the first home savings account, they'll have about $96,000 a year in discretionary cash flow that they can use for their lifestyle needs. We can see once they purchase the home at age 38, that their discretionary cash flow drops because they now have their mortgage that they need to pay, but they would presumably stop renting or doing whatever their current living conditions are. And so this would be their spending capacity going forward. And then we don't yet have a target spending for retirement at age 65. So we can once again rely on Snap, go to recommendations, click calculate under the sustainable spending. And Snap will tell us that they're on track for about $80,000 a year of today's purchasing power after tax all the way throughout retirement. So they'd be able to spend roughly at that level. Adjusted for inflation, they would spend $159,000 as of the first year, and that would deplete their accounts in the final year of the projection. So we don't have to know what the client's retirement will look like in order to still create valuable projections forward. It gives them a sense of how they're tracking and what their current plan would be able to achieve given all of our other assumptions. So once again, I'll stop there, see if there's any questions that we can tackle with the remaining few minutes.
Yeah, we've kind of gone right up to the end here, Steve. That was great. One quick question just about a joint plan and joint non-registered assets and how you can set that up. I know you gave them each individual non-registered account.
Yeah. So the reason that I set up an individual account is because from a investment standpoint, there technically isn't such a thing as a joint investment. There are joint accounts, but ultimately what it's intended to represent is one person or the other owns each dollar in that account. So when you enter a joint account, let's say that there's 100,000 in the account to start with, Snap is going to automatically split that account between the two spouses 50-50. So it's going to give them each $50,000 on their personal planning page. And that's because, from a tax perspective, someone has to pay the income taxes on all future interest and dividends. And so we can see here, this future non-reg account is now split between the two spouses, and it's $50,000 each. So you can include non-registered joint accounts. Snap is just going to split it to start with, and then it's going to track them as completely individual accounts going forward from there. So any new deposit is going to be in that individual's name, and any withdrawal is going to be explicitly in that individual's name. It is something that we're tracking in terms of, we're doing this for tax attribution rules, but sometimes it can create confusion for clients. So we're trying to marry the best of both worlds with simplicity and tax accuracy.
Perfect. Yeah, there's only 1 minute left, but okay, let's think. One quick thing. Why did Snap stop the contributions to the FHSA after 4 $8,000 contributions? Because you had already entered a past contribution. So maybe if you could just show where that past $8,000 contribution was. So the total is 40,000. It's just one of those
Yeah,
happened last year.
exactly. So we started the plan with 8,000 and we told Snap in the first home savings account settings that there were previous lifetime contributions of 8. So it's only going to give us 32,000 more in the projection. But if we look at the balance of the account, we can see that it does eventually reach that 40,000 threshold because we started off with 8 already in the account.
Terrific. Well, I
Awesome.
think we've run out of time,
Well,
but
I
we are here to
appreciate,
help.
yeah, appreciate all the questions throughout today's session. Really great and applicable questions. If we didn't get to yours live, I apologize. We will respond by email within the next couple of days. Once again, a reminder, we will be sending out a recording of today's session if you want to revisit anything. And we will also be sending out that survey to complete in order to get your CE credit. So please watch out for that email in the next 2 hours. If you have any other questions or would like to connect with our support team, please go to help in the top right and click on Help Center for all of our resources and contact information. Thanks and have a great day.